What's up everyone, it's Sandu Talks here, and today we're going to do a slightly different video. So right now there's only 3 words on everyone's minds: stock market crash. And today I was doing a bit of background reading and I came across this really great Forbes article which I just wanted to share as part of a video because it was jam-packed with a lot of useful knowledge. And I know a lot of you prefer to hear someone talking about these items rather than reading an article. Okay, so let's jump right into the article. How to Survive a Stock Market Crash by Joe Groves. Okay, so we start off and as we can see, the global stock markets have really taken a battering over 2022 due to fears over high inflation, rising interest rates and economic recession. Now, these two topics right here we're already seeing come to life. UK and US inflation is at a 40-year high. Rising interest rates, you're seeing that just on the day-to-day. For example, mortgage rates are going up as an example of that. And economic recession, it's become quite the buzzword, just being chucked around all over news articles right now. So, will that come true? Are we just thinking it into existence? I tend to think so. And building on that word, economic recession, we dive straight into US technology share prices. Now, the Nasdaq has a tech-heavy focused index, and this has fallen over by 30% since November. So let's dive a bit more into that. So this is the Nasdaq 100 technology sector. So it's basically all the largest US technology stocks all in this one index. And as we can see, around November, we were sitting at 9,800, going a bit down, going a bit up, but we were fluctuating around this 9.8, 9.5, 9.6, 9.7, wherever you want to pinpoint it. If we go to right now, we have fallen all the way down to 6,705 right now as of today. So the technology sector in the US has taken quite a beating, and we'll discuss this a bit more further on. So if we just go back to the article now, and then we go on to compare the UK stock market. So the UK has been a bit more resilient here. We've fallen below the 7,000 mark, but it's been quite steady, the FTSE. So I'll give you a bit of a preview on this. So here's the FTSE 100 index. So for those unfamiliar with the FTSE 100 index, it's just the largest 100 companies in the UK essentially. So this is a 6-month view, and we're only really down by 200 if I'm honest, 2%, 2.8%. So we're sitting at 7,400 and we're down to 7,200. So the FTSE has held up a bit more better compared to the US stock market, and that's because the US is quite tech heavy, and tech it's taken a battering over the past couple of months. Why is this? Well, if you look at the breakdown of the FTSE 250, I was struggling to find the FTSE 100 breakdown. But if we look at the FTSE 250, so 250 will just mean the 250 largest companies rather than 100. As you can see here, the breakdown it's heavily geared to financial service companies. Then we've got industrials, consumer goods. So these sectors, they're a bit more stable, and that's why the FTSE 100 and even FTSE 250 hasn't dipped as much as what we're seeing in America right now, because we're not growth stock geared, and we'll move on to the term growth stock in the video later on. So yeah, moving on, the next section is, well, what is a stock market crash? Because everyone chucks around the term stock market crash, but what actually defines a crash? Because if I take me for an example, I wouldn't consider myself a new investor, but I was around during 2007, the last major financial crash, but I was in like year 7, so I was a little nipper starting my GCSE journey. So I guess that does make me a new investor, because if we do go on to have a recession, this is my first recession as well, so we'll see what happens. Okay, so a stock market crash refers to a rapid fall in share prices, and 10% is a benchmark here. You can see here, this is defined as a drop of at least 10% on a stock exchange or major index in a day or a few days, and we've seen that in the US. We've seen it drop heavy like this. Now, stock market crashes may be temporary, recovering in days or weeks. For example, take COVID, we had a COVID stock market crash, and that lasted, a couple of months. We move on here, couple of months, but it's this question, years. Will this stock market crash last years? And we're going to touch on it more and more, looking at historical trends in this video. So major stock market crashes, as we said, trends. We've had Black Monday, we've had the dot-com bubble, we've had the global financial crisis, and we've had COVID, which I just touched on. And if you go back even further, you know, we had 1929, you know, the Great Depression, which is obviously one of the biggest crashes that has ever happened. So what actually causes a stock market crash? Because it's easy, again, shouting out these buzzwords, stock market crash, recession. But what causes it? Why do stocks begin to collapse? And it's important to know this because we'll move on to dollar cost averaging versus time in the market as well. So a crash typically occurs at the end of a bull market. In a bull market, you know, we have prices that have risen for several years and investors begin to question whether companies have become overvalued. You see, when the tide is rising and you're buying stocks and they're going up, investors begin to do less research because it becomes a bit of an adrenaline rush. You can just pick random stocks and they'll go up, and you have an influx of new investors that are just gambling their money away. And these stocks keep going up because we're in a bull market, so everyone thinks they're a genius, and then we have overvalued stocks. But that's not the only reason. We also have macroeconomic factors. So often this is what kickstarts a recession. You have a tiny nudge, a tiny macro nudge, and that causes a spiral of investors to panic, and then they start realizing they've been buying garbage. They've been buying stocks which are overvalued, such as growth stocks. The keyword growth stocks here. So what does this article go on to say? Well, inflation rates are at a 40-year high. We're seeing this. Cost of living is through the roof. I don't even need to explain this one. Petrol prices are going up, food prices are going up, everything's going up, mortgages are going up. The price of everything is just getting out of control. So that's what factor is playing a role right now in the potential recession. This is the factor, inflation rates. So why, you know, apart from the cost going up, what other damage can inflation rates do? So number one, valuation of growth stocks. Again, keyword. So in a bull run, well, we have two types of stocks. We have growth stocks and value stocks. So imagine a stock which imagine a company. It doesn't actually produce great cash flows. The company has great ideas on problems it wants to solve, but it's actually not generating any returns. So higher interest rates, it reduces the value of these growth stocks. Often growth stocks are measured by discounted cash flows. Investors don't care that they're not generating a profit right now. They have these forecasted models which show what the cash flow will be in the future, and that's what they're investing in. They're investing in the future cash flows. Now, when inflation arises, banks raise interest rates, and we've seen that on the news. The Fed have been increasing their interest rates. The Bank of England have been increasing their interest rates. That affects the future value of these cash flow models because these companies, they have high debt as well. Once you start tinkering with that interest rate, the whole model of cash flows changes and it reduces. Next thing you know, investors are like, I don't know if this is a good idea to buy anymore, and they panic. So that's number one. But growth stocks, it's a massive topic we can just dive into. One takeaway of this video, Google value stocks and growth stocks. It's such an important concept. So number two, reduce consumer spending. Now, look in the mirror. If you're like me, I've tried to stop spending. It's small, you know, I try not to eat out as much. I try not to buy alcohol anymore, you know, I'll buy like a bottle from the supermarket, but I try not to go to the pub and just buy beers and cocktails. Companies begin to face reduced demand from consumers. Spending is going down. So that's the second one. Now, return on savings. Now, if inflation is out of control, we know banks are going to increase interest rates, and that means it's more attractive to hold cash in a bank account because you can earn higher interest on it and it's deemed, you know, less risky. So those are your three main factors, well, negative impacts that are a knock-on cause from inflation. And the article also goes on to mention how the UK and US are also reducing their QE programs. So for example, the US currently holds a lot of stock on its balance sheet and it wants to offload it. Once that begins to happen, the stock market is going to fall even more. So we're seeing a tightening in policy by governments. They don't want to be giving out free money anymore. They're trying to rein the money back in, because that's how you control inflation. You try to control the money supply. Well, that's one aspect of it, and that's what they're trying to do. They're trying to reduce the supply. So trend is our friend. I've already said it a few times in this video. Well, this is a great graphic wasn't even by Forbes, it's by WSJ Markets. Great graphic here. So it's a bit limited in terms of history. It only starts at 2000s. So now this is the FTSE 100 index, and it's basically just plotted it out for the last 20 years, but someone's been helpful to put these indicators of when we've had market crashes. Now look here, dot-com bubble. We had a 52% fall in the FTSE 100, and it took 4.5 years to recover. That is actually mental. As I said, I've never actually experienced a recession, so 4.5 years of being in that much of a loss, it's a big one mentally. And that's why I'm probably also a new investor as well. You know, I haven't been in the game long enough to witness this, but we're all on the journey together here. That's the main key. We've then had, we've recovered. We've then had the global financial crisis right here. Again, a fall of 48%, so similar to the dot-com bubble. And interestingly, also around 4 years to recover. So very mirroring, and it's kind of scary actually how we had the dot-com bubble crash. We've risen back up. We've finally hit to where we were pre-dot bubble burst, and now we've fallen straight back down. I can't even imagine that, holding through 4 years of losses, finally being back to break even and then falling again. But anyway, we move. So then we've had a smaller stock market crash here. We had Brexit and issues in Asia. 22% fall, 8 months, that's a baby crash. And then we've had COVID pandemic. So this is the probably closest I've had to a real stock market crash. We had a 35% fall and 1 year and 10 months to recover. And I love this, to be fair. I was buying the whole way down. Every month I was just putting more and more in, just trying to capitalize on it. And I was mainly buying dividend stocks because I was trying to earn a bit of passive income. So as I said, this is a really great graphic. But there's one thing which really stuck out to me on this chart. As I said, FTSE 100 index here. Look at this, 2000. If you purchased in 2000, by 2022, you haven't really made that much. In fact, when I was reading the article, I think it said you would have maybe been about 10%. Here we go. Overall, FTSE 100 has risen 15% since 2000. Food for thought, a bit of negative food for thought, because people always tell you, invest in the stock market, and I'm guilty of this. Invest in the stock market and it's guaranteed 10% every year. Once you average out over decades, it's 10% every year. Well, in the FTSE 100 case, over the past 22 years, you've only been 50% better off, which is pretty crap if I'm honest. And this brings me on to a new point, which isn't really related to this article, but diversifying. So this is the FTSE 100. Obviously, the term chucked around by all these finance gurus is S&P 500. Now, although it's only risen by 15% over the past 22 years, if you purchased at the correct times, if you tried to time the market, you could have doubled your money. You purchased down here, you would have been laughing the whole way up. You purchased down here, again, you're enjoying the ride. And this is going to be I want to say controversial, but it is, but it isn't. So you always hear the term, don't try time the market, you need to dollar cost average. And hands up here, I am a fan of DCA, dollar cost averaging, because I don't think you can time the market. You can use certain factors to get better buy locations. So if we go back to the chart, you could have seen it, you could have been dollar cost averaging, it's tumbled here, you load up a bit more, you're like, oh, this is looking pretty good. You increase the amount you put in, it goes down a bit more, you increase a bit more. You can try time the market, but I want to show you the maths between whether you think dollar cost averaging is worth it, or if you should try time the market, because I want to present both sides to you. So I've got this website here. It's literally financialcalculators.com, and it allows us to calculate what our return on investment would be if we dollar cost average. So amount invested, so we're going to keep it small and simple. Let's say you put in £1,000 into the stock market. It's not a one-time investment. That means every year we're going to put another grand in. Again, these are small amounts. I'm trying to keep it simple. So let's say we 2000s when we start our journey. Website only goes on to 2021, so let's see where we would be at. So FTSE 100, let's scroll down. So you would be sitting at £26,000 and your total profit is 5.7. So over the past 20 years you've made about, just under £6,000, and your annualized rate of return is 2.2%, which doesn't look that impressive off the bat. So dollar cost averaging in this case, was it worth it? That's up to you to decide. Now let's do some comparisons, because again, this is FTSE 100 and I've shown you the FTSE 100 is more stable because it's more geared to value stocks, it's more geared to steady companies, these old dinosaurs of financial services. You got a lot of utilities, insurance providers. It's more stable. Their companies producing solid profit year on year. So let's go to, again, it's the same inputs, but I've done S&P 500 this time, the good old S&P. So by the end of 2021 you would have £68,000 and your total profit £47,000, and your annualized rate of return 9.7, which it's on track. It's near that 10% that everyone's always chucking around. So the maths works out on this one, and that's pretty good. You've put in, if you think about it, you've probably put in about £19,000 and you've ended up with this much as a profit. So dollar cost averaging, for me, that looks pretty good on S&P 500. For you, you might be like, still a bit bad. And then again, I've changed it. Investment number 3, I put I'm going to butcher it, but Hang Seng Index. So that's the Chinese index. And same inputs. Ending value 26,000, and our total profit is 5.7k. Same as a FTSE, but if I'm honest, I feel like China, it's kind of unfair to use China in this example because it was still in its developing stage, and I think from the next recession, I think China's going to really emerge as a key player. I think what we've seen on the S&P 500, we're going to see it with Chinese stocks next. It's just going to go on this massive growth. Because if you look at the history of stock markets, you have the European markets booming, crash, became more stable. You now have the US markets booming, crash. Will the US now become a bit more stable, like the FTSE 100, FTSE 250? Now is it Asia's time? Is Asia now gonna go on that bang run, 20, 40 year run of just 10% year on year churning it out, then bang, crash? Who knows what the next continent or country might be to produce these returns? So that's the maths behind dollar cost averaging. Whether you think dollar cost averaging is worth it or you want to try time the market, that's up to you. I'm not here to try drill in one method to you. We all have our own styles, and that's what people forget when it comes to investing. It's called, personal finance. It's called personal finance for a reason. It's personal. So anyway, back to the article. Great website if you want to check it out. It's just financialcalculators.com. I'm not endorsed by them. It's a free website. So back to the article. Let's move on. So should investors buy the dip or sell the fall, time the market? We've already discussed this just with what I've showed you, I feel. So I'm going to skip this section. And then we've got the big question. How do we protect against stock market crash? Even if a crash doesn't take place, I still think you should take steps to prepare. It's better to be prepared than not to be prepared in these situations. Sorry, just so thirsty. Talking really dries out the throat. Okay, so how to protect. Number 1, diversify into different sectors and countries. So I think we've touched this already, especially on the countries part. You've just seen the FTSE 100 has been quite an anchor in the turbulence we've seen. It's been steady, whereas the S&P 500 and the Nasdaq, it's dropped off a cliff. So if you diversify, you have a bit of FTSE, you have a bit of S&P, you have a bit of Asia index, and that means, during the good times, sure, you're not going to see a you'll still see a good return during the good times, but you might see other people experience better returns. But it also means on the flip side, when things tank, your portfolio doesn't tank as much, which is very good mentally because no one likes to see their portfolio go down. So number 2, diversify into different assets. Now, we don't need to just be buying an S&P 500 index fund all the time. We can buy non-equity assets. You know, there's so many investment vehicles out there. You've got bonds, property, commodities. You've even got, you can buy vintage cars, whiskey, Pokemon cards. There's a lot of investment vehicles out there. And you should try to diversify out of equity stocks. So this article has done a great little comparison. So what it's done is it's taken index funds, but these are index funds that are diversified into, I guess, non-stock things. So look, we've got a commodities index, 2022, 21% up, 24% up in 2021, only 4% up in 2022, well 2020. Infrastructure, 6, 13, -3. UK property, 5, 9, -4. UK companies, -9, 17, -6. North America, -10, but 26% in 2021 and 16% in 2020. Now imagine if you had a combination of commodities and North America, for example, in 2022, 2021, you'd been loving it, you'd been gaining so much in terms of return on investment. 2022 hits, we fall, but it's okay because you have commodity and natural resources now leading the way. Diversifying, that doesn't just mean buying different index funds, it means buying different sectors. No one is ever 100% right. No one. So it's okay to admit not being an expert, a guru who has 100% win rate. It's okay. You don't win all the time, and that's why we diversify. Number 3, timing your investments. Now, this section I'm going to freestyle a bit, but because my opinion on timing your investments, you know, we've already talked about dollar cost averaging versus lump sum. I think you should keep dollar cost averaging, but in times of recession, you know, if you think we're about to enter a recession, I still think you should be buying monthly, but you should be trying to also build let's say a lump sum saving account. Maybe you reduce your monthly contributions into your share portfolio. You know, you still buy a small amount every month, but then you start building this saving account, a cash account. So then as the market dips, you can lump sum in at high amounts. So for example, if you normally invest £500 a month and you want to try time the market, well, instead of investing £500 a month, why don't you reduce it to 250, save the other 250, and then when you think time's right, bang, all that cash you've saved up in this separate account from reducing your monthly investments, you then try time it. That way you're getting the benefits of both. You're still dollar cost averaging, but you're also hopefully going to time it well and benefit from a 50% gain, hopefully. Then we've got consider investing in total return funds. This one was a bit shit, so I'm going to skip it if I'm honest. I don't think you can read it if you want, you can pause it, but I don't really think this one's very worth it. And then we've got some other tips, minor ones. Set a stop loss. If you're investing in terms of decades, I don't really think it's needed. And hold some cash. That I've literally just covered that. Maybe reduce your monthly contributions to hold extra cash and then try time the market. So that concludes this video. I felt this article had some really good gems in it, and that's why I wanted to make a video on it and just show you guys or girls out there. Hopefully you enjoyed the video. Obviously, if you want to see more, feel free to subscribe, check out my other videos. If you have any recommendations or even any improvements I can make on my videos, let me know in the comments. If there's something you want me to talk about, let me know in the comments. On this channel, I cover both stocks and cryptocurrency, so feel free to check out my channel. There will be 2 videos popping up right now you can check out, which I really recommend. And we make videos every week, so hopefully catch you next week.